All right, welcome back to Global Mantra. We're still in conversation with Sanjeev Shah of Fidelity International on this very chilly afternoon in London. Sanjeev, what about exposure to energy companies then? Because that's one trade that people are talking about over here. That's one reason why Russia is, gaining ground in terms of finding favor. Would you reduce exposure, build exposure to energy companies in the background?
I've got some exposure to sort of energy-related companies, but it's actually quite small. I own a company called Cairn Energy, which is clearly listed in India as well in terms of Cairn India, etc. That's the only exposure that I've really got to the whole sort of exploration and production space in the UK. Also, I've got some exposure to BP, for example, and that's largely because they had a really terrible crisis with the whole sort of well disaster that they saw, and there was an opportunity to really pick up an unfashionable, unloved equity at that point in time. But apart from that, I haven't got much exposure to sort of energy-related companies at all.
All right, both the companies that you mentioned, have been in the news. Cairn Energy being bought out, the India stake being bought out by Vedanta, and then BP, of course, tying up with Reliance for the exploration blocks. Is that the kind of expansion that you fancy when you're looking at these stocks? These kind of news bits, do they encourage you as an investor?
Not really. When I invest in stocks, I take a 2 to 3 year view on my investment decision. As I indicated to you, like with BP, they had a very tough crisis, 6 to 12 months ago with the whole well disaster that they saw in the Gulf of Mexico. And that created an opportunity to really buy BP on a longer term horizon and to benefit from the rise in the share price that we've seen since then. So short-term news flow like that doesn't really drive me, in a major way. Similarly with Cairn Energy, for example, I think they've got the potential to exit out of their Indian position over time. But importantly, they also have a very unique position in exploration in Greenland, which is overlooked by the market quite often. And I think that's potentially a multi-year story, which looks very interesting.
Oh, what about Vedanta Resources then in this entire thing? I mean, would you want to take exposure for the kind of global footprint the company is building itself on right now?
Okay, unlike a lot of other fund managers, I'm very negative on the whole commodity space. So that includes, for example, Vedanta. So for example, whereas for my, investors, the benchmark in terms of commodity-related stocks is roughly 12% of my index, I have virtually no exposure to commodity names in the portfolio. I've got some exposure to gold names, but very little in base metal stocks. Why is that? I'm much more negative on the whole demand-supply environment for commodities. Why is that? Largely because I don't think the underpinnings of a strong economic growth environment globally are in place, given all the things that we see in terms of the developed markets. I think also I'm more positive on the dollar versus other currencies, and that would normally be a headwind for commodity-related stocks. And I think also as one shifts in the emerging markets to a more consumer-driven and service-based dynamic, I think the marginal demand for commodities will reduce, especially in places like China, for example.
In short, do you hold a view on the deals independently, the Vedanta Cairn deal or the Reliance BP deal?
I wouldn't want to comment on that specifically.
Fair enough. What's the broad view on China? You think it's a strong story?
I think structurally, longer term, it continues to be a very attractive place to invest. Certainly on the consumer side and service-driven side, but there will be volatility. I mean, it's the nature of the market that one operates in. It's emerging. But whereas in the West, for example, the policy and the sort of corporate governance is very well established and works very well within well-defined limits. In emerging markets like China, all of the institutional frameworks are all relatively new, and there's less checks and balances. And hence, I think, in terms of corporate governance and policy risk, clearly that's higher in places like China. But over the longer term, I think you have to be positive on the long-term outlook for China overall.
What about emerging Europe? What's your view out there? Are you looking or evaluating opportunities in that region?
When you talk about emerging Europe, it's largely, for example, places like Poland and Hungary. And I think you also mentioned before, you mentioned Turkey, for example, although Turkey is not strictly clearly part of Europe. Poland and Hungary, look, I have looked at those, but not in any great detail. I think what puts me off is firstly the fact that, it's much more driven by external financing than sort of, internally driven financing. I think also that sort of the macro situation in these markets is less sort of clear. Turkey, for example, I think, the budget deficit and the trade deficit longer term is potentially unsustainable, and also, again, it's largely driven by external financing flows, and I think hence it's more vulnerable. So if I was to play emerging markets, it would be probably more the emerging markets which are driven around global growth drivers, like, for example, Korea, than actually domestically driven markets like Turkey.
Okay, Sanjeev, before we wrap up, two questions really. You do not have any exposure to India, but a lot of Indian companies are getting listed on the AIM, on the London Stock Exchange, especially energy-related companies. Do you look, because stock exchange consolidation is the way forward for a lot of foreign investors to kind of spread their wings in different regions, do you see an opportunity there to get some exposure to India? Do you evaluate stocks?
I do evaluate them, but again, I come back to the point that I made, is that I think, my negative view on commodities, including the energy-related space, leads me to conclude that in a lot of these areas, this is the sort of final stages of the bull market that they've seen. So what you normally see at the end of a sort of a bull market run in a specific sector is more listings, more M&A activity, and more raising of money. And I think we're at that stage now in the whole commodity space. And I think that's what we're seeing in terms of listing activity in the UK, for example.
So for a lot of European funds, such as yourself, are you looking at, in any way to expose part of your portfolio in a limited sense to the emerging market growth story via the the stock exchanges here in London? I mean, via the LSE or the AIM?
Okay. Again, a lot of the listings have been in the commodity-related space, the energy-related space, and I think it's very difficult to play what I think is the most attractive part of the emerging market story, which is the consumer. And so I can find that through, for example, listed companies in UK and Europe, for example, the luxury good companies, which are benefiting from the growth dynamic of the consumer in the emerging market. But in terms of actually emerging market companies who are listing in the UK, I think it's very hard to find those opportunities.
Sanjeev, before we wrap up the show, just one word on how you see the year ending. I mean, 2011 and the beginning of 2012. What kind of a micro environment do you see for global markets and for a fund such as yourself?
Okay, I come back to the point that we've seen a very strong run in equities since March 2009. I think we're in the latter stages of the run in equity markets in the short term in both emerging and developed markets. I think from some time in the second half of this year, we could go into a longer term consolidation phase in equity markets in general. Why do I think that is? I think that's because we've had a very strong V-shaped type recovery from the low. And I think investors have got the potential to confuse what is a strong sort of a V-shaped type recovery and extrapolate it. And actually, I think, what the environment is going to look like longer term is a very dull, low growth economic environment for the foreseeable future.
And how do you define long term in this scenario?
For the next 3-4 years.
So the return expectation in that kind of an environment on the higher end, or perhaps even in terms of underperformance, I mean, what would that be? What would be a range of return expectation in that light?
Well, look, I mean, in the shorter term, I think there's a little bit more to go for an equity market. I then think there's going to be a longer term consolidation phase in the markets overall. But I think that will give another opportunity to invest in equities. And I continue to be bullish on equities longer term. Why is that? Because I think corporate balance sheets are in a lot better a position than they were historically. I think, things like cash yield and free cash flow yields are still very attractive. So that looks attractive. M&A is starting to pick up as well as financing market opens up, etc. And I think today, growth at a reasonable price is very cheaply valued by the market.
So you're a buyer at every dip?
I would say for every substantial correction, I'm a buyer, yeah.
All right, so we leave it at that. Thanks very much for joining us. With that, we come to the end of this episode right here on Global Mantra. Catch me with another special guest from the City of London as we carry on the series from here.